Hey, it's Jason here, and in this video I quickly want to talk about one of the biggest things I've learned in having gone from having no idea what I was doing about how to buy a company to having done that now twice, and I am on the lookout for other opportunities. We don't jump at things unnecessarily, but we are always looking. And one of the biggest things I've realized is that how you go from 0 to 1 is very different than how I would recommend you go from 1 to 2 or from 2 to 3. In other words, going from 0 to 1 really, in my mind, is a different process than is scaling your existing business. And this is something I don't see a lot of people discussing, the talking heads on the internet. I don't see people who message me or send me direct messages. I don't see them realizing this. But as somebody that's practicing business and business acquisition in the 2020s and now in 2021, I see this as being so relevant and so important that I quickly wanted to discuss this distinction with you. So first of all, going from 0 to 1 is really about bootstrapping, in my opinion, unless if you're well capitalized. But I'm speaking to you as if you're not well capitalized, like I was not well capitalized when I started. Right? When I started, I was not well capitalized at all. I mean, I was literally sleeping on my grandmother's couch. At some points, I was sleeping in my rental car up in Iowa and in Nebraska and in South Dakota before I closed the first deal in Nebraska. I was grinding it out. And if you're going to start this process of getting into business via making a business acquisition without a lot of capital, A, it can be done, but B, you have to be very careful to ensure you don't personally bankrupt yourself, which is one of the biggest areas of failure in my estimation for people who get started, is they don't take into account their personal financial situation and they bankrupt themselves. And when I say bankrupt, I don't mean they lose everything. Most of the time, if you're in that position, you don't have a lot of assets, but you just run out of money and you can't continue, right? Which ultimately means you failed. But if you're going from 0 to 1 and you don't have a lot of money, the areas I see people mess up mostly are with the professional firms, the accounting firms and the law firms. And often what people do, and I did this at first and it set me back several months, is you engage with a Skadden, or you engage with a Deloitte, or you engage with a Day Jones, and these are different law and accounting firms. And they'll say, oh, you can do it on a success fee basis, you can defer the fees, you can pay it later. But the problem is if you're going to be buying that first business in that $1, $3, $5 million deal range size, that small 7-figure acquisition. And when I say small 7-figure acquisition, I mean, it's a profitable business, it's a proper business, but there's only so much meat on the bone that those businesses provide by definition. And what I can tell you is those large firms, the fees will basically eat into the profit margin of those businesses at a disproportionate level that doesn't make the value arbitrage reasonable for you as the acquisitions entrepreneur and as the founder. So one of the first areas I think going from 0 to 1 is unique is that unless you're going to go out and try to do an 8-figure deal right from the start, which for most of you, I don't think is a realistic goal to set for yourselves. And I know what some of you are going to say is you shouldn't have realistic goals. I concur. Your ultimate goal should be ridiculously large if you're super ambitious. And if you're going to get into business for yourself, I recommend having super large ambitions. But you can have super large macro ambitions while still being pragmatic in getting there. Ultimately, I want to build a massive unified group of plumbing and HVAC companies that are able to work together to be super successful so that we can thrive during economic recessions, so that we can take care of our guys and pay them a little bit more than our competitors, so that we can buy materials at bulk rates and basically create economies of scale. So I have a $1 billion macro goal. But the route to get there is actually quite pragmatic, and it doesn't need to be some crazy, thing where, oh my gosh, how did you pull that off? I mean, yeah, it's difficult, and a lot of people are surprised at what I've done over the last 2 years, and candidly, sometimes I am too, but the steps can actually be pretty pragmatic. And so, for example, I don't think you need to, and I don't recommend that you engage with one of these big accounting or law firms right out of the gate. I would much rather suggest that you work with an accountant, a qualified accountant, a qualified M&A lawyer, and you have those individuals do the accounting and the legal functions for your first deal or two. Why? Because you're strapped for cash. And if you get a $30,000 bill from a law firm and another $25,000 bill from an accounting firm the day after you close your first deal, and the business is only producing $400,000 a year in income, you just ate, 10, 12, 14% of your first year's income before debt service. You also have debt service, assuming you finance the deal using a bank, which means really you just ate up like 15 or 18 or 20% of your first year's free cash flow. Well, that's capital you could have used to pay yourself, to pay your partners, to reinvest back into the business, to do all these other more valuable things that candidly move the needle forward far much more so than accounting or legal. I can also tell you that on a deal that's in the $1 to $5 million deal range size, which is where I got started and where I would recommend most of you get started, especially if you're strapped for cash, you can just read line 21 of the tax returns of the business, add in interest and taxes and amortization and meals and owner's compensation, multiply and add all those things up, subtract it by 50,000 because that's the amount you're going to pay yourself a year as a base salary, and multiply that number by 3, and that's the earning multiple from which you should pay for the business. Well, the earnings is, again, the line 21, which is the reported income, plus interest, plus taxes. I don't use depreciation. I don't recommend you use depreciation. But I would also add amortization. I would add in meals. And I would add owner's compensation. I would take that number, subtract it by 50,000 because that's the base amount that the bank is going to expect you're going to pay yourself as a salary. And then I would take that number, say it's $500,000, and I'd multiply it by 3. And that's how much I'd pay for the business. There, I just taught you how basically right there, how to analyze the financials of a business in 60 seconds. Okay, so you don't need a KPMG or a Deloitte to do that for you. Not on a smaller deal like that. Can you do it? Sure. But I would do it yourself, and I would have an accountant come on that you can compensate with equity instead. It's going to save you a lot of money. With the legal stuff, the law firm, the lawyers, get a lawyer, give them 3, 5, 7% of your parent company, or give them 3 or 5 or 7% of the specific deal in equity, and have that individual set up the legal entity. Have that individual draft up the operating agreement. Have that individual draft up the asset purchase agreement or the stock purchase agreement. I would recommend you make an asset purchase if possible, unless if there's extenuating circumstances wherein you need to buy the contracts of the existing business to really have a strong business, in which case a stock purchase agreement makes more sense. But really, you can bring on a lawyer that you give equity to and make a partner of yours, a minority partner of yours, and have that individual do the legal work, and then you just compensate him with equity as opposed to cash. And what that means now is your first year in business after you make the acquisition, you're not stressing the hell out of the business with a big lump sum to pay each month in debt, plus accounting fees to pay off and legal fees to pay off, plus all the other expenses of the business. You don't want to over-lever the business. You don't want to over-stress the business. Take it from somebody who's been there now and who's done this over the last 2 years. Trust me, you don't want to overstress the business. Overstressing the business is the fastest way to ensure you're not going to pay yourself, and it's also the fastest way to ensure that the business is going to be risked to go bankrupt. Remember too that you're going to have to overfinance the deal to some degree to get sufficient working capital. So when you add all those other things that, the transaction fees and overfinancing the deal to get working capital, I made a video about how to get working capital, by the way, on the YouTube channel here, so check that out. But when you add all those things up and then you add on the accounting and legal fees as well, and oh, by the way, it's a smaller business that only does, say, $500,000 a year in earnings, which may seem like, oh my God, that's a lot of money. Yeah, well, maybe it's a lot of money compared to a 9-to-5 job. But remember, that's only if things go right. And you have to think about it from that perspective. 2020 showed us that things can go wrong in business. Things can go wrong in business. A lot of people went bankrupt in 2020. You avoid going bankrupt when times get tough by thinking strategically and not spending unnecessarily. That's my theory. And that allows you to stay in the game, to keep making more acquisitions, to keep exploring joint venture opportunities, to keep growing your business, to keep recruiting talent to help you build your dream. You can't keep building your dream if you're going bankrupt. And it's a lot easier to go bankrupt if 20% of your year one's income is going to professional fees. So that's a big area where I think a lot of people are getting it wrong. Now, once you do a deal or two and now you're looking at 8-figure deals, then yeah, bring on the accounting firm. Maybe you do bring on the law firm. And now it's maybe $30 or $50 or $70,000 in professional fees, but you're dealing with 7-figure incomes a year. So the amount of the fees compared to the income becomes much smaller. Maybe it's only 3 or 5% of a yearly total bottom line income. So now things are more proportional, which is why how you go from 0 to 1 is different from going from, say, 1 to many. Here's another one. Getting your first deal itself, sourcing the deal. Unless if you're very well capitalized and you're willing to show off your personal bank accounts and the bank accounts of your partners, generally, you're not going to get a lot of respect from brokers before you've done a deal. You don't have operational credibility, and you probably don't have a lot of capital. So getting your first deal really is about just smiling and dialing. That's how I got my first deal. We smiled and dialed, and we found a deal. We found a lot of deals. I drove throughout Iowa and Nebraska and South Dakota looking at them, selected the one that made most sense, and we got the deal done. And that's how I recommend you do it as well. Now, subsequent deals, things change because then you have a track record, you have more credibility, brokers and investment bankers take you more seriously. Now you can look at all types of different deals, on-market deals, off-market deals, pocket listings. Pocket listings are the select deals that brokers or investment bankers have that they aren't posting all over the place. They're not posting it on bizbuyforsell.com, but they're deals they have in their back pocket that they only show to qualified buyers. Once you do a deal or two, you now become a qualified buyer in the minds of bankers, investment bankers, and brokers. Thus, they will show you those deals, right? So how you source deals changes from 0 to 1 versus 1 to many. There's a lot of things that change. A lot of things that change. For your first deal, you're probably going to want to go through a seller finance note, maybe an SBA loan, maybe a commercial loan. But it's easier if you can do seller finance or SBA. Once you get multiple deals done, or once you're looking at your second or third or fourth deal, now you can more easily talk to all the different lending options out there. And you're gonna have more credibility with those lenders. Likewise, it's gonna be easier for you to get into the room of bigger deals once you get that first one done. I told a story here fairly recently on the YouTube channel about how we closed the deal here in Tampa Bay, and within a month, I was getting access to deals that were 10 times bigger. Literally in revenue, 10 times bigger. Within 1 month. So that happens. I was not getting invitations into rooms. I was not getting calls. I was not seeing deals that were at that multiple 8-figure in sales range before I closed my first deal in the utility sector. As soon as I did, floodgates opened up. One thing I hear a lot of people saying is, I'm going to go out and I'm going to immediately do an 8-figure or multiple 8-figure deal. The problem is those people who DM me that stuff and tell me they're going to do it, they never send me that follow-up DM of, hey, I closed that deal. And I know why, and I never want to burst their bubble, but the reality is when you don't have a track record, sellers, nor bankers, nor investment bankers, nor brokers are going to really take you that seriously by and large, unless you have a big built out track record in your professional life already. But if you don't, I've been there, I've done that. I just know you're not going to be taking that seriously to get started. So you get started with something where you can have enough credibility to get the deal done. And that's usually a smaller 7-figure deal. And then you parlay that credibility to get access to the bigger deals. So that's another one. Your first deal is to set up subsequent opportunities for yourself. In my case, my first 2 deals really were to set me up because I parlayed from one sector to another. But these are some things I've learned that I wish I was more aware of when I got started. I wish I was more aware of the distinction between going from 0 to 1 to going from 1 to many. Another thing I wish I understood at the very beginning was how difficult it is to find great partners in business. When I got started, I built a big old team for Brighter Living. I think 10 or 11 equity holders were in the parent company at the very beginning. It was 9 plus me, like 11 or 12 actually. I had a big team. And if you go on BrighterLivingProperties.com now, you'll see that there's 4 equity holders, myself and 3 others. So we went from 12 to 4, roughly speaking. We're at 4 now. I think we were at 12 before. 75% cut. And what I now realize is it's very difficult to find great partners for you. Doesn't mean that people aren't great. Often they are not great, candidly, but they may be great. They may just not be great for you, for your team, and for your vision. And so one thing I learned, and this is actually something I just believe in general, but especially going from 0 to 1, don't be so liberal with bringing people on and giving them equity, especially at your parent company. And if you do give away equity, have a vesting schedule. Probably a 4+ year vesting schedule. And don't give away a whole bunch of equity right away, because most times in business, the business relationship will end in a divorce. And that's something I've learned. And truthfully, that's actually one I've just learned that I believe is true, whether you're going from 0 to 1 or from 1 to many. You know, if you've owned a business and had employees, usually employees eventually are going to work elsewhere. I mean, you look at resumes of applicants and they worked at this company for several years, and then maybe they worked at that company for 8 years, and then maybe they worked at this company for a year. People move on. Seasons change. There's nothing wrong with that. You prefer to build a team that's going to stay along for decades. I do, at least. But when you're building a team, just know that it doesn't always work that way. So it's best to be conservative and hope for the best, but plan for the worst. And that means not bringing on a whole bunch of people right up front, or at least not making commitments to them up front. Make commitments to less people so that you have less areas of potential problem. If you bring on 12 or 14 people, I can just tell you the law of large numbers basically guarantees that not all of them are going to work out. So that's another area I wish I would have known more about up front. But look, as far as the differences between going from 0 to 1 to 1 to many, ultimately I would say it's about not engaging with professional firms unless you're very well capitalized. I would say it's about realizing you're just gonna have to smile and dial most likely to get your first deal. And I would say it's about realizing that it's gonna be very, very challenging to get an initial 8 or multi-8-figure deal done ASAP. And settling in quotes for a 7-figure deal to get started is not a sign of weakness. Rather, it's a pragmatic step that sets you up to do what you actually ultimately may want to do, which are the bigger deals. And equally, you can live a pretty good life too, even with just one 7-figure acquisition. I mean, you'll see this when you engage with sellers in that 7-figure deal size range. They have boats and nice cars and nice homes. I mean, you still do pretty well with a 7-figure business. Some of you are extremely ambitious like I am, and I like the money, but I'm actually more ambitious just because I have a vision I want to create in the sector I'm in. The money will come if you build enough value, and the money is the byproduct. That's my theory and philosophy on business. You can agree or disagree on that. But those would be some things I've learned that I would really take to heart. And with that, there's the video. If you've liked this one, thumbs it up. Subscribe to the YouTube channel for more business, finance, and M&A content coming from a guy who's in the trenches doing it in the 2020s. And that's it. Go to jasonpaulrogers.com for more. jasonpaulrogers.com/free-training/ if you want to enroll in a really powerful free training. And with that, I'll see you around. Take care.